Hello, everybody. Welcome to Friday, another Talk Money with Tom show. I want to thank everybody for coming to the show today. Looking forward to trying to help everybody out with their finances. Of course, we have this show here to answer your questions. We try to help you with asset management questions, how to handle taxes during your retirement, the overall planning, Monte Carlo simulation, all the different things that we like to talk about here. And so, of course, you can send in your questions now if you want. We'd love to answer questions live. Just kind of makes it interesting for us. You can send those questions during the week, too, if you want to give us a chance to answer them, with a little bit more detail. And you can do that by sending to this email address, or you can put it live into the chat here if you want, if you're signed in. So. And then, of course, we created this channel because we feel like the educational level, that revolves around retirement planning and how to handle your finances in retirement is a little bit lacking. So we have a lot of videos on here. You can get on, subscribe to the channel, hit the little bell button when we put new stuff in there as far as that goes. And then, of course, if you just want to meet with us and talk about some of your questions, we offer a free consultation for 30 minutes. And you can go to our book appointment button, which is on our corporate website. The link to that website is here on the channel. Schedules live, set up a 30-minute time to speak with Ethan and I on the phone, video, come into the office, whatever, works for you. So anyway, look forward to being able to help today. I do like to start off every week, and it's been a couple of weeks since we've done this show. I'd like to start off every week with, kind of what's happening in the stock market overall. And so if we look at, the chart that we kind of study on a regular basis here, we've had a pretty substantial run, right? From that big drop that happened, really right after Liberation Day, which was the 2nd of April, where the shocking high tariffs, at least shocking to the market, happened. And then we had a pause, and the market had a huge recovery. And that recovery has continued even though tariffs have kind of go up. And we'll take a look at that and kind of what's happened here as far as that goes. But it continues to run, right? And so it's kind of, getting a lot of questions from clients is like, why, if all these things are happening, is the market continuing to run? And because if you look at it, we're actually seeing, the gross domestic product has slowed down, right? We were at 2.3% last year. The first half of this year, we're at 1.2%. So economy's slowing, the job growth. This was a big deal. We didn't do the show that Friday, but that a couple Fridays ago, we got the job number, came out at 73,000. But what was more important was they readjusted the previous 2 months quite dramatically. So like 144,000 jobs was knocked down to roughly 14,000. I'm kind of making this up, but that's, it was a huge drop, like a 90% cut for the jobs that were reported in the previous 2 months. And so, the market dropped quite a bit, more than 1.5% that Friday. But the dip buyers are still there. The people that believe this market is going to continue to do well are still there. And so it's kind of this continued battle, a teeter-totter battle. And I think what's happening is that a lot of, if you look at the interviews and look at what's going on, a lot of the big money actors, the hedge fund managers and what have you, that are more kind of that more traditional money management style, are looking at the tariffs and the possibility for inflation there and saying, hey, let's back out here. Let's just hold, we have a third out for the same purpose, right? And so, and what's left is these people that believe, first of all, the tariffs won't have an impact because maybe Trump will, reverse course. They love the artificial intelligence, which is going to make up for everything. Even though things might slow down overall, maybe it gets picked up because artificial intelligence is creating higher productivity, right? All of these different types of things. And you do have all these kind of quant funds in there now. There's a lot of computerized trading programs that are in the market that they don't care which way the market's going.
Yeah, they just trade on the price movement.
Right. And so the price movement's up, they're buying and buying and buying. Price movement's down, they're shorting. So when you take out one chunk and they're all sitting on the sidelines, what you have left is the people that believe this thing's going to go, right? And we'll talk about, why it could go, and we'll talk about why it might not go as far as that goes, because I think that's important coming forward. But at the moment, the market, I think it's really healthy. I mean, every single time we have a little bit of a dip, from a pure price standpoint and momentum standpoint, price action standpoint, it's a good market. I mean, it really is a good market. And honestly, if it wasn't for tariffs and some of the things that I see that are possible problems coming up, and I didn't know about those, and I was just looking at price, we'd be in. just like last year and the year before, because again, action does matter. So let's go through some of the things that happened. So first of all, just quickly, the Consumer Price Index came out this week, and it was at 2.7%. So it was year over year, all right? And if you look at that, it's a 3-year chart, pretty anemic, really, for quite a while. Right? I mean, up a little bit here, but nothing. It was actually expected to be at 2.9%. And again, this is top line, all included food and energy inflation.
Yeah, gas really held it down.
Yeah. Gas was down 9% year over year. And so, yes, exactly right. And so some of the pieces brought it down. But even on a core basis, with taking out food and energy, the CPI was still pretty reasonable. Didn't seem like any effects really from the tariff. Now, like we did last time this came out, we dug into some of the categories that are tariff related, and they're going up quite a bit, right? Okay, they're just not a big enough category to offset some of these other areas that are kind of coming back.
A lot of those are kind of one-time expenses.
Yes.
A lot of these goods that are people tariff expenses, and so a lot of people just are not buying them.
Yeah, exactly right. That's kind of interesting. So that's where you get into kind of a slowing economy, and we'll talk about some of that too here. Okay, so we presented this 2 weeks ago on the show, and so this is just kind of what are the precursors for seeing the CPI or the PCE, the two kind of consumer price indexes that would show increasing inflation. What are the things that move first before that? So again, this is hard to see, but that orange line, okay, that is the ISM Manufacturing Prices Paid Index. So when that orange line's going up, like you can see at the very beginning of the chart, the manufacturers are paying more. Yeah, and then you look at the purple line, which is the CPI. That's what consumers are paying, and so you can see the lag. When that orange line goes up first, eventually that purple line catches up, and just the opposite. Notice that the orange line came down before the purple line came down, right? And so now, if you look right over our heads, you can see that big spike, right? It is way up, and the purple line hasn't moved yet. All right. So today or yesterday, we got another precursor for possible future inflation increases into the consumer, right? And that was the producer price index. So again, this is going back, for a 3-year period, and you can kind of see it was trending down more or less for the year, and then jumped up quite a bit. And this chart's a little bit hard to understand, but this is how much it moved month over month.
Yeah, it was a really big spike.
That was a huge spike, actually. Matter of fact, it's the biggest we've had going back for 3 years. So what happened was, so that if you look at like June of this year versus July of this year, which is month over month, it jumped by 0.9%. And interestingly enough, goods went up by 0.7%. Services went up by 1.1%. So that's the second time I've seen services gaining more. And they're not affected by tariffs directly, right? But they're being affected by probably increasing wages and different things along those lines. And actually, when you break into services, one of the biggest things you see is insurance. Whether it's auto insurance or fire insurance, both are being affected by these big calamities. Because when there's a huge hurricane, flood, a lot of autos get damaged, as well as homes and
especially as their prices increase too. It just becomes more costly to insure.
Yeah, I think I forgot what the numbers were, but they've determined that they're being allowed to increase here in California our homeowners insurance by was it 20-something%. Was because they have to go through the commission to be able to. They have some caps, and but it was quite high because of the Palisades fires and the different things that have happened. So, anyway, so this is a precursor. So if we look at manufacturers start to pay more. Right now, wholesale prices start to gain, and then eventually you'll start to see gains in that CPI. So the prices are going up. There's no doubt about that. The foreigners are not paying the tariffs. American importers, American companies, and eventually American consumers are going to pay these tariffs. Okay, that's for sure. I can hang my hat on that. However, we're not seeing it, fully in the numbers to see what that split is, because it does matter. If it all goes through to consumers, they'll start to be able to pull back, and that's when you start to see things slowing down. If on the other hand, the other extreme, it all stayed with companies and they just ate it, you're going to see less hiring, more layoffs, and slower growth because
you see the market react very negatively to that.
Yes, exactly. So maybe even more so by companies keeping the tariff money in-house and not passing it on than you might if the consumers were paying. You might see more market reaction to that, right? So this is the tariff picture. This is from the Yale Budget Lab, which if you get a chance and you're curious about how this is all working, they have a really good website. They update it very consistently each time tariffs change. So we're up to an 18.6 effective average tariff. With the, you can see that bump there was like 50% to India. We went from, I think, 25% to 50% on India. Might not stay there, because it's sort of a negotiating tactic. But you can see it was way higher for a while right after Liberation Day, mainly because China was at 145% for a bit. And then once they kind of dealt with that, it started to come back down. So now, please note that at the beginning of this chart, the average effective tariff was about 2.5%, right? So we've come a long ways, and so that whole thing, that little, bump in tariff costs is going to work its way through this entire economy, and then just long term, this is kind of fascinating. This is going back to the 1700s for what our average effective tariff rate was since 1790, and so we had much higher tariffs prior to 1900 than we have now. We had no federal income tax. And so the way that they would generate income to fund the government at that time was through tariffs and to protect some smaller industries and things along those lines. And the last big tariff we had was 1930, and you can kind of see we're close to that now as far as that goes. You can see we went straight up from being quite low. And what happened there was, of course, unemployment was at 6%. They wanted to try to protect, American industries and drive unemployment down. But of course, it went the opposite direction, which is what's going to happen now also. Unfortunately, it went from 6% to 25% unemployment. And stock market ended up dropping a total of 87% from its highest point to its lowest point. And so that's kind of created this scenario now through accords and what have you. You can see, decade after decade, the tariffs have been coming down. Free trade has become, and we're reversing that whole trend right now. I will say, if you look at that 1930 tariff, and for the most part, those things don't stay up like that. It probably won't stay up. So that could be a good thing. So that's, I think, partly what the market's relying on here is that tariffs at this level won't work. They will start to create problems, and Trump will make an adjustment to those tariffs to bring them back down. I still think there probably is some tariff rate above 2.5% that they could do, but it's probably not 18.6. Matter of fact, it's probably in the single digits, but maybe high single digits. I don't know, And so, and that would be okay, right? As long as you could do that before something fell apart. And that's one of the big problems that's happening right now. There are people like Jamie Dimon running around saying, hey, even a small recession could create a really big recession if things start to fall apart behind the scenes. And he's specifically talking about private credit, which has expanded dramatically. And so, these are loans that don't have regulations. And again, it's the same problem we had with the bad mortgage loans that happened in 2008.
Because it's private, there's limited data. You just don't know what they're doing.
We don't know how much there is. Just like during 2008, we didn't know how much credit default swaps there were, which are these insurance policies that sit on top of these mortgages. And apparently it was $7 trillion that was set up in 5 years because it was private, right? And we don't know what level of loan it is in terms of the quality. I mean, are these junk loans, great loans? I mean, what's the overall issue? And so what happens is when loans start to default, these companies are trying to scramble around and cover those defaults, right? And whatever assets that they might have can often be sold. And that's what we saw in 2008. That's why diversification didn't work in 2008. Everything went down. Gold went down, IBM went down, Cisco went down, everything, because these companies are having to sell to pay off these credit default swaps, right? So that's always in the back of the mind here once you start pushing on something as hard as we're going to push on the economy here. And the Yale Budget Lab has a projection for what they see happening to gross domestic product going forward. And you can see it starts to drop, okay? That's a negative, at least up until the bottom of that is the second quarter of 2026. So almost a year from now,
Mm-hmm.
right? So between now and then, we'll continue to see if tariffs stay at this level and don't get adjusted, right? Which is a big if. It will continue to see gross domestic product, according to them, continuing to erode. Okay, so again, that's what Jamie Dimon is talking about. That's that little bit of something that can turn into a bigger something. Okay, and so that's the line we're walking right now. Tariffs could be a nothing. They have been a nothing so far, especially for the stock market. They could be a nothing all the way through if they're able to kind of pare them back down, or if by some miracle, even at these levels, things are so different in today's world and there's so many other compensating factors that they don't matter, right? That's possible. However, probability makes me feel like I want to be 1/3 of my stock market exposure, my normal exposure out, and 2/3 in. Because that's the bet, okay? 2/3 in because things could work out. There's a lot of positives happening. The big, beautiful budget bill is good for the stock market, those kind of things. So, all right, now, here's the other reason to be 2/3 in or more, and that is because the Federal Reserve, as I think they're likely to make a rate cut in September. I would like to review that statement after the Jackson Hole speech, which happens on the 22nd of this month, and see what Powell says, because we're seeing both. We're seeing a decrease in the employment market, which is what they'd want to support. We're seeing the gross domestic product slow down, which is also what they'd want to support by lowering rates. But we're also seeing prices going up. If you look at, the 0.9% growth in wholesale prices that just happened yesterday, so they're going to be in the spot where, so this is the Fed Watch tool. Currently, we're at 89%, bet by the market that by the 17th, I believe it is, of September, which is when the Fed will meet, they'll be reducing by 1/4 of 1%. All right, that's vacillated a fair amount here as data comes in. There's still a bunch of data that needs to come in before this happens, right? We're going to get the PCE inflation report at the end of this month. We'll get another,
CPI.
Another CPI. We'll get another.
PPI.
We might get another jobs report. They fired the person producing the job report numbers, not person, the person ahead of all of that. There's a big group of people, but and one of his comments was to maybe do it quarterly. Seems to have shot that down even on his own, just because it's probably pretty important. I will say though that it isn't partisan. I mean, the jobs report that we get, which is a big number that's really important, the market reacts to, gets revised pretty dramatically. It's incredible. I don't pay as much attention to it as I used to because of that. So nonetheless, there's a comment of don't fight the Fed, right? The Fed starts to reduce rates. Generally speaking, the stock market does well, but not always. Right? They started to cut rates in 2007. The stock market dropped 57% from that point in time. So sometimes when they're cutting rates, it's because they really need to, and things are falling apart. And in 2008, we had something behind the scenes, in this case, Lehman Brothers, falling apart and collapsing really the financial system really struggled in that period of time. So that's where we're at this point in time. I think it's pretty interesting. You could make a strong argument that this market's going to do well, that the deregulations, the lowering of interest rates, the big beautiful bill with the taxation reductions, the artificial intelligence excitement, money being spent there, power generation, all of these areas outdo all the other issues, which would be the possibility of higher prices caused by deportations and tariffs, right? That's the battle that we're kind of dealing with. And again, I'm on the side of believing that the market will do well to the point of being 2/3 in, but I am 1/3 out just because of, our clients, this is their life savings, right? The T-bills are paying well right now compared to where they were before. So that's not a terrible place to be for a bit here and see what happens. So anyway, we'll see how this plays out. I think, as we go week by week here, it'd be really interesting to see, what happens. I've been talking about the impacts of tariffs hitting in August, September, October, beginning of that, feel. We get some feel, and that's exactly what's happening. We just got that PPI report starting to show things yesterday. And so, again, it's working its way through, and we'll have to see what type of impact it does have. as far as that goes. So anyway, thank you for joining us for this summary for this week. Look forward to being able to do this again next week. All right, let's start with our first questions.
So why is the market expecting the Fed to cut interest rates while inflation is rising? And should there be a cut?
Yeah, okay, so if you look at it, the Fed Reserve has a dual mandate. They need to keep, unemployment low, which for them is 4 point something, low 4 point something, and keeping inflation on the measure of core PCE inflation, which comes out at the end of the month, down to 2%. Okay, so inflation is going up slowly but surely, and precursors for inflation. Prices paid by manufacturers are going up. The producer price index, the wholesale index went up yesterday. And so we're starting to see, that working its way through the system to eventually start to hit, the consumer. And so if they raise rates in a normal world, when you're raising rates, you would have a situation where you're potentially stimulating more demand, which could create more inflation.
Yep.
But this is different, and I think they can do a rate cut here. I'm not sure they should, but I'd be okay if they did it, that's for sure. And here's why, because this inflation is not being caused by too much demand.
It's by the tariffs are causing
Right.
it. It could be a one-off inflation.
That's
event.
right. And so, and what we're seeing, I believe, is more weakness than we had certainly by this time last year. And so if you come in and you start to do rate cuts, you're going to make that less weak, right? It'll get better. But it might not get so much better that it creates this big demand influx because money's so cheap, we're going to go buy all these things and we're going to do all these things. So I think that, their fear of igniting inflation by lowering rates once or twice this year, which is the big bet, right? September, October, if you look at the market bet, it's betting for a decrease. I think that logic is what they're looking at personally. That because if we didn't have tariffs and we had a 0.9% wholesale inflation, there's no way they should do any rate cut. No way.
They would be talking maybe possibly raising rates.
That's exactly right, because now you're talking about, without tariffs, this is demand driven, right? People are buying and buying and buying and going crazy. We need to slow that down. And they would start talking negatively like they do, right? They start saying, oh, the stock market's terrible, not in those words, but it works. And that's what they did in 2022. They do what we call job owning. And so, but this is different. The tariffs are being caused by sort of an artificial piece that's coming through. And even if it stays, it's a one-time thing.
Yeah.
It could be huge. Because, 0.9%, if you had that every month for 12 months, is 10.8%. The average effective tariff is 18.6, so you could see 10.8 on wholesale price. I have no issues with that at all. It would be dramatic, and I think that's the problem. And it would be so dramatic it might slow things down even more, and that's where rate cutting now instead of later could offset. You maybe get into a stagflation area instead of a massive recession area. So anyway, I think that's why they're looking at it. Again, the stock market is excited, really excited about the possibility of rate cut. You can see it on a day-to-day basis as the numbers
whenever
come
the
out.
rate cuts go up, the market goes up.
Yeah, it's very, very directly related as far as that goes. And so I don't know that the rate cuts are that great. They're not even that much in effect. I know that
quarter on the 4.5%,
right,
4.2 to 4.5. It's not the biggest cut.
Yeah, it's not going to make. I guess it's still directional. So anyway, that's if demand is literally dropping down because things are softening, which there's lots of reason that can be happening, and prices are still going up for an artificial reason for tariffs, you can still probably lower rates and bring demand up some without really affecting the ultimate price because there's not enough.
You're not generating enough demand to cause it to continue to go up.
No, I don't think so. Especially at these small numbers that they're looking at. So I would err on the side. You look at that, the projections are the gross domestic product is going to drop even more because of these tariffs. And so again, you're trying to prop up demand that's already falling. You're not going to create inflationary demand when demand is coming down. You have some room to cut rates to kind of keep demand even where it is, and the prices will still go up because the impact of tariffs are still coming in. But you can't stop that, other than making demand go down even more, which means creating a recession. Which, honestly, I don't think they want to do that either. They are very concerned about not being a situation like we had in the 70s where inflation got out of control. That's for sure. So anyway, it's a great question. I think it's a nuanced thing that you kind of have to understand how these things work. But I believe there's room, and I believe that's why the market's betting that they're going to do it.
So have you noticed a kind of like a diverging opinions between retail and institutional investors on the current market? Have you, because a lot of institutional investors have kind of gone more conservative in their positioning.
Yeah, it's hard to tell, statistically exactly what's happening. But if you look and kind of listen, yeah, the interviews with these big money managers, big fund managers, big hedge fund managers, they're all warning about the possibility of things falling, right?
Mm-hmm.
And so they've made their changes back in March, April. Heck, Buffett started in November, cutting back right after the election. He saw the potential for problems, right? I mean, he wasn't right either. He was really ballyhooed in April when the market was down, but the market's higher than it was when he got out and started getting out in November. But these big money managers and these big people they kind of understand the overall cycles, and it's very impossible to figure out exactly where that top is. I mean, I would suppose that Buffett looks at this and says, okay, tariffs are not good. We're going to have tariffs. We're just going to sit back for a while with some of our cash and gather and come in like today, or the announcement of buying United Health. That's these guys that come in and buy low, and so I think that the institutional investor has been waiting this out, sort of like we are with at least our 1/3 allocation, for the stock market out. However, when you look at the market, you can see the retail investor coming in. I mean, they've been there since 2020. Every time, so last Friday, the Friday before, I can't remember, the jobs report came out and they revised it all. So that's 2 weeks.
Yeah.
And so that whole thing dropped 1.6%. I can't remember, very surprising to the market. And
next day it was basically.
Oh yeah, Monday it was up 1.5%, right? And we're up back, boom. And we have we ended up with a week that wasn't huge altogether, but still, the dip buyers there. So the retail investor is still playing. There is a lot of people talking about these Quant funds, the automated buying, it'll buy up, down. They're making a big impact also. So if you have like all these people that are with this big money just sitting on the sidelines, it just leaves the people that believe that the market's going to go up. They believe the AI is going to outdo everything. They believe the tariffs won't have a big impact one way or another, and they believe that the rate cuts are going to be stimulative, and that's a great argument. I have no problem with that argument. That's why we're 2/3 in. And so, there is, though, more concerns than there would have been at the same time last year. Again, so anyway, so I think there is a little bit of a and I've read so many articles that the average retail investor by far was not involved in the 2008 downturn. They're younger. They're under 40 or less. And so, buying the dip is great until it drops 57%, right? Yeah. That's where it becomes a lot more difficult. And
unless you have the fortitude to keep buying through that dip.
Yeah, exactly. And it's a bit more challenging mentally to do that, that's for sure. Because you don't know where the bottom is. I mean, in the Great Depression, it was 87% down. So you're buying at 57, you're getting a great deal in hindsight, but it could be worse. Mm-hmm. So that's the problem that can really affect people, and as far as that goes. And the use of margin is up. There's a bit of a wild spirit coming into the markets right now.
Yeah, there's a lot more with Robinhood and just the proliferation of option trading.
Yep.
There's a little bit more of a wild west feel.
There is. We're not at that because I've been talking about that pattern from the 95 to 2000, the dot-com pattern. We're into that. It's starting to happen, right?
Yeah, you can see it with the Schiller PE index, right?
Yeah,
It's
yeah,
up
you're
there.
you're seeing with the PE indexes, the long-term, the Schiller PE index. You're seeing it with a few IPOs that are coming out. Some of them are kind of hot. You're seeing some of these crazy stocks that are, somewhat related to AI doing fantastic year to date. So it's not the crazy. That's still coming. If it doesn't get killed by these tariffs and what have you, we're gonna have a fantastically really high upward moving market like we did at the end of the last one. And that's when you want to be more cautious eventually too, but yeah, that could be 2 times higher than it is
Yeah,
now.
you never know where the top is
No,
either.
no, it could be big because there's a lot of money slushing around out there still. So anyway, it's a good question.
So, if I feel there's a dip coming up in the next few months, should I lower how much I am investing and then hold that extra as cash? Or should I try saving more money and holding it as cash and just having something ready to buy the dip with? How would you, if you felt kind of with some conviction that there is going to be a dip, how would you adjust your investment style?
Okay, well, we do feel that there's going to be the possibility of a dip, and we are keeping 1/3 of our allocation out. So the way I look at this is the same way I look at 2022. The story is still the tariffs. It's the difference. Take out tariffs, and you've got a market that I would be fully invested in.
Yeah,
I would
you'd be
just
flying pretty high.
So then I would just be looking at it from the standpoint of tariffs. So as tariffs, are they still here? Yes or no? Yes. Okay. And what are they at? They're at 18.6%. That's super high.
Yeah, are they getting
Okay.
worse or better?
Okay, and now what's happening with those tariffs? And so if they're starting to get better and better and better, if the court takes them away, there's lots of things that Trump, comes backwards and says, "Oh, this isn't working well. We're going to lower them." I'm investing into that marketplace. They continue to stay there. They've basically been, potential is still there to go up. He's still talking about big tariffs on pharmaceuticals and semiconductors and, all these things. We're not done. So that 18.6, we could get higher than that on an effective basis. So that's what I look at. What's happening, with tariffs? Actually, we'll go back to that one chart real quick too. Let me see if I can get to that quickly. So this is the tariffs year to date, right? So kind of still growing right now. Yeah?
Yeah.
You look for last 6 to 8 weeks, still going up. So as long as that chart means a lot to me. You start to see that coming down, or at least some of the rhetoric changing. So to me, that means that there's going to be a dip, all right? Now, it might not happen if they reverse those in time, or by chance all these other things are so good they outdo this, right? But that's what I'm looking at right there for figuring out what I want to do with my, average investing or whatever I might be doing. I'd be gathering cash right now until that starts to change. I will say the one caveat to this is that Fed rate cut, not fighting the Fed, is also a really important component of that. So
Would you just basically slow your investment rate and then hold a portion in cash rather than, completely stopping your investment?
yeah, I would slow 2/3 in, 1/3 out. So if I'm putting in $300, I'd put in 200 and save 100 into cash. Yeah, I feel really good with that balance in this market.
And even with that $100, you put in
Yeah.
a high yield savings, you're still getting a little bit over 3.5 to 4%.
Right, yeah, so it's kind of like what we're doing with the T-bills, right? Exactly, because I just feel like that's what we got to watch. We got to watch that chart right there and see what's going on with tariffs, and maybe pay some attention to what the Federal Reserve is saying and or doing. I think there could be some impact there too. But anyway, it's a really good question. I think that, it goes to the heart of the way I look at investing is about probabilities, right? When I feel like the probabilities are quite high that the market's going to continue to go up, I'm fully in, And matter of fact, we even have some leeway to push our targets into slightly more aggressive areas, right? Which is what we did in 23 and 24, and we did quite well with that. But this situation now with the tariffs and deportations potentially impacting inflation, and what type of cascade effect that could have, we're in territory that's really difficult to tell. And a lot of professional money managers, including Warren Buffett, have pulled back, all right, because they can see the history. We study the history. And, it's not always right. Believe me, that's what makes the market so interesting. But It's worth looking at from a probability standpoint, and you got to figure out what that means to you. All right, what's our next question?
So the California Fair Insurance is becoming more burdensome. The Fair Insurance for the California is kind of like it's a last resort insurance provider. You know,
For what type of insurance?
usually for U.S. or for California, it's the fire insurance. A lot of areas are losing coverage for fire insurance, and so the Fair Plan is kind of their last provider. Um, and so the question is it time to consider moving with the just increasing costs? And what should I consider when I move to a new place? What should I be looking for in that new place?
That's kind of two questions. Should I move? And if I do, where should I move, right? So, should you move because of the fire insurance increase? Doesn't seem like it's going to get much better,
No,
right?
and I think this year they're expecting 33% increase in
Yeah.
premiums.
Well, I've seen some huge numbers from some clients that have big houses up in the woods, Montecito, Saratoga, Los Gatos, Los Altos Hills, where their situation is, they had insurance, they got dropped, they found another insurance, they got dropped again
Mhm.
within a year. And now they're on to their next insurance, and they basically have gone up more than 5 times, 500% increase. And they're really kind of picking on these houses that are worth, like, say, more than $3 million in a wooded area. And, that, that, they hired that in 1995. They hired that gentleman from Stanford to predict, that California hired them to predict where the worst fires could be in California. Number one, Pacific Palisades.
Mhm.
Number two is Orinda. And number three is Los Altos Hills. So they all have the same thing. They're in wooded areas with expensive homes, right? So the structural cost and damage would be, severe into those areas. And so obviously he was right about Pacific Palisades. And, these insurance companies don't want to deal with this.
They have to stay solvent,
Right.
and so they have to raise premiums if they have to have big payouts.
It's kind of interesting, though. I don't know enough about this, but where would you go to avoid that problem as a whole? Um, because we've got floods that are happening in different places. We have hurricanes that happen. Earthquakes aren't so prevalent outside of California per se.
You could go to a colder area where it's more just blizzards and storms. Usually those don't cause major.
Yeah, although you do get
damages.
some trees. Arizona, is that a good place? So anyway, I guess that's one of the things. If you were moving because of your insurance, then that's part of the consideration. However, the other parts of consideration for moving are probably more important because they're potentially life or death scenarios, and that is making sure wherever you go has awesome medical facilities available.
Yeah, or a good elder care situation too.
Yeah,
in case
'cause
you need that.
We've seen it, right? We've seen our clients, they sell their house here, they move up into the Sonora or, Arnold area or whatever it is. It's great up there. They love it. However, in several of those situations, the clients have gotten sick, cancer, whatever it might be, Parkinson's, and they end up having to, somehow get back down to Sacramento, Modesto, San Francisco, whatever, to get the care that they need. And so it's transportation back and forth. And then you're exactly right, actually. The hospitals can't really handle it on an emergency basis the same way. Like, we can go to Stanford here, emergency, right? And so if you're up in Sonora, you're going to some little hospital that really doesn't have a lot of big-time specialists that are willing to work there.
Mhm.
And those are the people that are going to try to save your life. So that's where you still probably end up in a fairly high dense area if medical is an issue, because they really don't have great medical in low dense areas,
Mhm.
low density areas, right? At least in my experience. I'm sure there's some exceptions to that.
Yeah, and
But I'd be looking for that.
think about is it a fit for you personally? Are you, whether is the culture there the fit? Is the demographic where you want to be? And so I always recommend staying there for
Mhm.
prolonged time. Maybe rent an Airbnb in a residential area so you can understand the culture, the people, kind of walk it. Also, what are your costs going to be? Are your costs going to be less because you're moving out to this area? Are they going to be expensive, comparable? Or how does that affect your retirement? So just understanding the whole cost. Just because you're saving on the fire insurance, are you paying extra some in another category? you make up.
Yeah, exactly. So, like, you move to Texas, what's the cost per house compared to what you're selling? Weather's an issue, obviously. What are the insurance issues that happen there? Where am I in Texas, for example, that has, the medical that I want? There's probably plenty of good places there that you could be living. Um, what are my costs there? But, so they don't have an income tax, which is great, but they have a property tax that's quite high. I think it's roughly 3 times higher than our property tax. And it's also readjusted every 5 years to some number.
Yeah.
So, you could have an increase if your house is gaining in value, which you love here, but at the same time, you could be having an increase in cost in your retirement that you can't control whatsoever. And they've had a huge jump in their property values, especially since 2020. So you have to take a look at all those things. But I've had a lot of clients move, and they take very good care to try to figure out where to move, and they're pretty happy.
But yeah,
There's a
majority of the
place-
people that I
right.
see that move, they end up, taking their time to search, but they usually end up pretty happy with their pick.
Yeah, I have not. I actually have one client who is not happy with her decision to move from West Coast to East Coast. She's really struggling with really kind of the culture and who she gets to speak to and what have you. But that's really rare. Most of the times, people have thought it out. They are really excited. Whether it's moving into a assisted living, independent living, or just moving to a house, or whatever it is. I'd say 99 out of 100 times that I've had somebody do that, it's worked out quite well and they like it. And so there is a place for you. If you're unhappy with what's happening, it's where you live now. There's probably some place out there that would work for you. You do get other complications. I mean, one of the things that happens for us here is that we've made a lot of money on our homes. And yeah, your insurance is going up on your fire, and maybe you live in Los Altos Hills and your house is worth a lot, but you're going to get hammered on the taxes when you sell it to move to wherever it is that you want to move to. And so that's kind of a golden handcuff for a lot of people.
Yeah.
Do you really want to spend $1 million in tax, let's say, to move from?
Yeah, that's when you start to consider, is it worth it renting versus, and then seeing that if you could offset the cost of living there.
Yeah, but you get the same problem that your house is in a fire zone.
Yeah.
Exactly. But if somebody passes away, if you're a joint owner, then or a married couple, then you get the step up, and you could avoid the $1 million in tax, and so maybe that's a better time to do it, and you just eat the cost of the insurance as part of the situation that you're dealing with. So yeah, it's becoming a much bigger issue. It's a lot of money being spent for some of these houses for the fire insurance. It's really going up. I can see why, but it's not easy to deal with. All right. Well, that's our show for today. Thank you so much for coming. I really enjoyed some of these questions are spectacular. So send some more in. Keep them going. If you've got a question about something, somebody else probably has that same question. They can watch the show. We tend to carve the pieces up and put them out on the channel so people can just look at specific questions. So help us out. Send us something that you're thinking about, and we'll try to answer that on the next show. Sometimes some things come in that are so far out in left field that don't really apply to many of our clients. But so you know what we're talking about, and you can send that in just by that email address that's here, asktom@talkmoneywithtom.com. You can go to our channel and subscribe to the channel. Specifically, I'd hit the bell button to get notified when new content comes in, so you can kind of keep up with what's happening. We talk about a lot of current things. We talk about the current market, the new tax changes, like we went over the whole big beautiful bill. So this will keep you up to date, at least on the things that I think are important. Whether you're 20 or 80 or any place in between, a lot of these things are going to be good things to get to know and to understand, and even just to understand the language, right? And of course, if you'd like, you can just meet with Ethan and I, phone call, in person, video, whatever it is. We'll give you 30 minutes for free. You go to our website. The link is here on the channel. Hit that book a point button, and we'll chat with you about whatever it is that you're thinking about. Be happy to help. We have a very successful practice. We don't have to beg and borrow for new clients and what have you, we are more than willing to kind of help out. And we enjoy that. So look forward to being able to see you again next week. And I'll start again, of course, doing the daily videos like I did this week, Monday through Thursday. And we'll do the show again next Friday. So look forward to seeing you then. Thank you very much.